Today, no real wage rise for you, or you, or you. Hello again, it's Martin North from Digital Finance Analytics World. Now, this post is covering finance and property news with a distinctively Australian flavour. Well, we know that inflation is raging, and non-discretionary inflation, for example, is officially at 6.6%, although actually it's a lot higher. But the International Club of Central Banks, responsible for controlling inflation, has backed the Reserve Bank of Australia and Philip Lowe by warning that wage price spiral risks are flashing red, and they've called for front-loaded interest rate hikes to avoid a 1970s-style stagflation. If central banks fail to tame inflation and wages claims, interest rates would simply need to rise sharply, risking large drops in asset prices that could trigger a sharp recession and financial stresses, the Bank for International Settlements said. And the BIS also said that raising interest rates meant governments could not rely on economic growth to reduce their debt burdens, following a similar U-turn by Treasury from its more relaxed position about budget deficits under the coalition government. Treasurer Jim Chalmers warned on Sunday that getting spending under control would be necessary in the October 25th budget, and he said inflation would be significantly higher than the previous government forecast and that public debt repayment costs would rise. Backing up Dr. Lowe and implicitly warning trade unions against supersized wage claims, the boss of the Swiss-based BIS said on Sunday that the most urgent concern for central banks is the trajectory of inflation around the world. With the prospect of higher wages as workers look to make up for the purchasing power they lost, inflation could be high for long, BIS boss Augustin Conceded said in a speech to launch its annual report. Employers exert more effort to recoup lost purchasing power, both actual and prospective, and firms seek to protect themselves from profit squeezes. Augustin Conceded said that with wage chasing prices and prices chasing wages, a damaging and self-reinforcing increase in inflation can follow. This combination can lead to wage price spirals and make a transition to a high inflation regime more likely, and now the lights are flashing red. Wage growth is already on an upward trajectory in some countries. In many, the bulk of wage negotiations are still to come. Demand for compensation for past losses, indexation, and a return to centralised wage bargaining have already surfaced. As unions demand pay rises of up to 6%, businesses beyond Qantas are turning to cash bonuses to retain and attract workers while trying to avoid permanently ratcheting up base pay, according to recruiters. And Dr. Lowe was in Switzerland on the weekend, meeting with foreign central bankers as the BIS report was launched there, and he admitted that there was only a narrow path to curb runaway inflation without triggering an economic downturn. If workers and businesses did not believe that the RBA could chart a credible path back to its inflation target, this would then force the central bank to impose much higher interest rates and squeeze the economy, he said. In fact, Dr. Lowe doubled down on his wage warnings after coming under attack by trade unions last week for seeking to put a lid on broad wage growth at 3.5% and cautioning against bigger across-the-board pay hikes that could fuel a 1970s-style wage price spiral. Australian businesses no longer felt constrained from putting their prices up, he said, while workers were demanding that their pay packets kept pace with surging inflation. It's not formal wage indexation, but it's indexation of a kind because you can understand why people faced with high inflation want compensation for it, especially when the unemployment rate is as low as it is, Dr. Lowe said at a UBS event on Friday night, Australian time. So there's a shift in the inflation psychology of the country. With inflation forecast by the RBA to hit 7% by the end of the year, Labor has been softening its pre-election push for wage growth to at least match inflation after the 5.2% increase in the minimum wage this month. Dr. Chalmers neither supported nor condemned ACTU Secretary Sally McManus's attack on the RBA, saying he respected her as well as Dr. Lowe, and they are not far apart on wages. you think about the point that Sally McManus is making, it's an uncontroversial one. And that's that wages growth right now is nowhere near 3.5% and nowhere near headline inflation, Dr. Chalmers said on the ABC Insiders programme. Phil was making a similarly uncontroversial point, which is if you let inflation get out of control, that's damaging for people's living standards. And we want that wages growth to be sustainable. Dr. Chalmers said that Labour's focus was on the lowest paid and that boosting worker productivity and participation through skills and cheaper childcare was part of the sustainable solution. Dr. Chalmers spoke on the weekend to US Treasury Secretary Janet Yellen, who is trying to contain inflation of more than 8% and her wages break out. Echoing Dr. Lowe, the BIS said to avoid entrenched high inflation, it will be important to heed the lessons of the 1970s when an oil price spike was followed by wages being indexed to high inflation. Experience shows that shorter and front-loaded tightening cycles tend to make soft landings more likely than shallower but more drawn-out tightenings, the BIS said. After raising rates by 0.5% of a percentage point this month, Dr. Lowe said a 0.25 or 0.5% percentage point was on the cards for July. A larger 0.75% of a percentage point increase, like the US Federal Reserve, was not on the table, Dr. Lowe said, because the RBA met monthly, more often than the Fed, which meets once every 6 weeks. As interest rates rise, the BIS's Dr. Conceded said tensions with fiscal policy will emerge. As monetary normalisation gathers pace, growth rates will probably be closer to or even below interest rates, said Dr. Conceded, a former governor of the Bank of Mexico from 2010 to 2017. Consolidated fiscal balances will quickly deteriorate. Achieving fiscal sustainability is essential, not least to restore buffers in advance of future shocks and recessions. And Dr. Chalmers said despite the budget deficit narrowing to $33 billion in the first 11 months of the financial year, commodity prices were now falling and there were undisclosed fiscal pressures left over from the coalition. We shouldn't assume that those budget improvements are an ongoing feature of the budget, he said. If you consider this $1 trillion of liberal debt that we've inherited, the costs of servicing that debt as interest rates go higher and higher, we do need to get a handle on spending. And the BIS advised central banks and governments to rely less on interest rates and spending to manage the economy, with more focus on growth-friendly fiscal actions and structural reforms. Such measures have been absent for many years, the BIS said. We should also accept the reality that if we want to have resilient, accelerated and sustainable economic growth in the future, with more opportunities for everyone, we need to depend less on the healing powers of fiscal and monetary policies. Now, the Reserve Bank Governor of Australia, Phil Lowe, is correct to say that the average level of wage rises should be about 3.5%, according to 2 in 3 surveyed readers of the Australian Financial Review. Well, no surprise there, of course. Dr. Lowe said annual rises in the mid-3s was a good anchoring point for employers and unions, even as inflation is forecast to reach about 7% by the year's end. 64% of those surveyed agreed that those wage rises should be about 3.5%, while 24% disagreed. The remaining 12% were undecided. And readers were also worried about the effect that higher wages increases would have on inflation. 72% of surveyed readers said they were worried about the increasing cost of living, while 24% said they were not concerned. Only 4% were undecided on that question. If wages increase at the current rate of inflation, business costs will rise, which will result in businesses failing, employer redundancies, and/or an increase in the cost of goods and services. Wage increases need to be restrained to avoid getting into a nasty cycle that will severely impact lower-income families, one reader said. Another reader said wages increase that match the current rate of inflation would create a nasty cycle, with the Reserve Bank further increasing interest rates to curb inflation. However, others disagreed with the idea that wages growth should be suppressed due to concerns about rising inflation. It's absurd that so much attention should be given to suppressing wages increase below inflation, but there is not a word about suppressing record profits far above inflation, a third reader said. And a fourth reader said business returns have grown more than wage returns, so it's time for major businesses to bear more of the inflation burden. For me, the key point is this, that over the last decade or so, company profits have boomed while wages have not. And we're in the situation now where our economy is very staggered towards and biased towards business. So it does seem to me that we need to understand that wages growth needs to come through because many people have gone backwards for year after year after year. And it's a design feature, not a blip. So the question now will be whether in fact the new government will continue that same philosophy or whether in fact we go somewhere different. I don't think that the idea of squeezing wages when inflation is low and also squeezing wages when inflation is high makes any sense at all. But hey, that is because, of course, if you start from a neoliberal philosophical point of view, then the market is everything and business is everything. Never mind broader society. But back to the Reserve Bank. Because the Reserve Bank has conceded that the disorderly end of its yield curve control policy last November triggered market volatility and dislocation alongside damage to the bank's reputation. But the central bank says its policy lowering funding costs pushed credit into the economy and provided insurance against bad outcomes. That's the main conclusion of a lengthy review into the Reserve Bank's use of the yield curve control policy, enacted in March 2020 at the height of the pandemic-induced market panic, but dropped last November amid market pressure. As a monetary policy tool, the yield target contributed to insuring against extreme downside risks by lowering funding costs and reinforcing the other key elements of the package of policy measures, the RBA's review said. In its application, however, and with the benefit of hindsight, the yield target could have ended earlier. And the policy involved paying the 3-year bond rate to the overnight cash rate target setting with the intention of lowering the cost of borrowing out of that term. The target was also a de facto commitment that interest rates would not be increased for that period to give borrowers further confidence to take on debt. But the policy met an undignified end last November, as early evidence of rising inflation led the market to test the RBA's ability to maintain the target. As selling pressure increased, the central bank chose to stand out of the market, concluding the policy no longer had a purpose. The RBA conceded many financial market participants were burnt by its decision to drop the target, including those that expected it to be retained. As such, this experience could lessen the effectiveness of any future commitment to this nature by the bank, the review said. The extent of reputational damage caused by its retreat was an ongoing question, but can only be assessed in the long run. Many other central banks have also been surprised by the strength in the economic recovery and inflation, with associated reputational costs and large movements in market prices, as forecasts and the forward guidance based on them have not been met, the review said. And the RBA said that there was also a financial cost involved in defending the target because the bonds it purchased fell in value as yields rose. But it said those costs were modest compared with the costs of its bond purchasing or quantitative easing program and its term funding facility policy. In future, the RBA said it would be more likely to opt for quantitative easing, which involves targeting a quantum of bonds rather than the price or yield. This provided greater flexibility and avoided the exit issues associated with the yield target, it said, adding that QE was not without its risk. The bank will conduct a review of that policy later this year. Despite its ill-fated end, the bank said the policy worked for most of its existence because it prompted a record take-up of cheap fixed-rate loans that boosted the economy. The setting of a low 3-year borrowing rate led to historically low fixed and variable lending rates for borrowers. In response, housing and business credit growth picked up to the fastest pace in over a decade. But of course, we're now reaping that whirlwind. Those low borrowing costs worked by freeing up cash flows to support households' financial positions. The unusually strong house price growth response by the standards of previous reductions in the cash rate was an important impetus in progress to employment and inflation goals through the usual channels of dwelling investment and consumption, the review said. And that's a really important statement because that does signal that they actually intended this to happen. Well, more shame them. Economists and RBA watchers said the report was more self-critical than they expected. RBC Capital Markets economist Su Lin Ong described the view as detailed, frank and quite transparent. She said that of interest was the board's agreement to strengthen the way it considers a full range of scenarios when making policy decisions. Perhaps this will deliver greater scenario analysis and policy options with a clearer reaction function as a key outcome of the review. Economist Saul Estlake said the Reserve Bank's error was putting a date on how long rates would stay at record low levels, which to the best of my knowledge no other central bank did. It's not often that people in high office admit that they got something wrong or acknowledge that their reputations have been hit. So it is to the Reserve Bank's and Governor's credit that they have done so on this occasion and indicate that they've learned something from this experience, S. Lake said. And meanwhile, ANZ economist David Plank said the bank was honest about the issues. Let's not be too harsh on them. Hindsight in 2020, at the time things were happening at a furious pace, he said, the market thinks there's a chance that it's going to exit. You either have to own up all the bonds or you have to give up on the target. Either way, you end up in a difficult position. And Richard Quinn, the head of fixed income fund Bentham, that had actively shorted bonds throughout the first half of the year, said it was bizarre that the central bank stuck to its dovish prediction that the cash rate would not go up until 2024. They were so wrong and had the opportunity to be a bit more normal about things earlier in the year, and they didn't take it, he said. The view is not the first examination of the efficacy of the policy. In May, the New York Federal Reserve report concluded that yield curve control policy helped stimulate the Australian economy, but its efficacy broke down once the bond market lost faith in the central bank's grip on monetary settings. The Fed study found that yield curve control most operated through a super narrow channel where only specific Australian government bonds targeted in the RBA's purchase operations were affected, but there were no spillovers elsewhere. The RBA bought up the targeted bond but achieved little else, it said. In other words, the policy failed to achieve its main purpose to ease financial conditions. The forced removal of the peg at the hands of the market led to criticism of the central bank, including by former Treasurer Peter Costello, who said its credibility had suffered. The RBA has come under constant criticism for not doing enough. In November 2020, former Prime Minister Paul Keating scolded the bank for not engaging in quantitative easing, which it eventually did. And in May, Governor Philip Lowe acknowledged his incorrect forecast that interest rate increases would not occur until 2024 was an embarrassing error as he lifted the benchmark rate. And the Reserve Bank will also face an independent review, which garnered bipartisan support, marking the most detailed examination of its capabilities since the 1997 Wallace Inquiry. So if you put this all together, 3 points. Firstly, wages rises will be nowhere near sufficient to deal with the rise in inflation. Secondly, inflation will probably rise faster and stronger for longer, thanks to the RBA's rather inefficient processes up to this point. And thirdly, unless things change, the reputation of the RBA is not going to change. They have frankly led us up a garden path. And the point I want to leave you with is that the forces of inflation, although it's being anchored back to Ukraine and the price of oil and other fuels, is also linked to the quantitative easing program itself. If you print lots of money, then the value of the dollar goes down. That means you have to spend more dollars. That means you get more inflation. It's so simple. People just look past it, and yet quantitative easing has created this inflationary problem. That was the central bank's critical policy. The bottom line is this: inflation was created by the central bank, and the lack of wages growth was a policy set by government for at least a decade. Unless those two things change, we could very well go through the same process again, and that would be very bad for Australia and Australians. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.